Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullah. In this video, I'm going to discuss and explain the material covered in chapter 5, which focus mainly on the determination of forwards and futures prices. And also, we will learn how to value forward and futures contracts. So let's start. At the beginning, we need to distinguish between two categories of assets or two classes of assets. One is called consumption assets and the other is called investment assets. Now, the relationship between the forward and futures prices and of an asset and its spot price depends on the type of an asset. So, investment assets are assets mainly held by a large number of people purely for investment purposes. So, the reason for people to buy and keep this asset is mainly for investment purposes. Assets like this include financial assets in general. It includes gold, silver. Now, even though silver is sometimes used or consumed as a raw material in some industrial products, yet it is considered as an investment asset because the majority of people, a significant number of people, buy silver as a way of investment. On the other hand, consumption assets are assets that are bought mainly for the purpose of consumption. So people buy these assets in general to consume them. Examples include copper, oil, corn, wheat, and so on. Now we will be learning about the concept of no arbitrage, or the pricing by no arbitrage, and we will see that the arbitrage arguments could be applied to investment assets but not to consumption assets. So we will see that sometimes we can or by looking at a certain price, we will determine whether this price respects the rule of no arbitrage. Otherwise, there will be an arbitrage opportunity, and participants in the market will try to take advantage of this, and the forces of the market will correct the price and until we reach a point that an arbitrage opportunity does not exist or it's impossible. Now, in the case of consumption assets, we will see that sometimes this is possible, and other times the arbitrage arguments are not. Before we start, we want to revisit the concept of short selling. In chapter 1, we discussed a little bit about short selling. Here, we will look at short selling in more details, especially when the asset that's being short sold distributed some income, like an asset like dividends or interest payments, while the short position is open. Okay, now short selling means or involves selling a security that you do not own or another asset that you do not own. To execute a short selling order, you will ask your broker to short sell a certain asset. The broker will borrow the security from another client or from their own portfolio of assets, and they will sell them in the market in the usual way. And you will benefit by getting the proceeds or the fund that the broker received after selling the asset. And why do people short sell assets? Well, they short sell assets mainly because they believe the price will go down. So if they bought something, if they sold something at, let's say, 100, they're hoping that the price will fall and they will be able to buy at a lower price, and then they will return the asset to the party who lent it to them, and the transaction is covered completely. Now, you have to keep in mind that when you short sell an asset or a security, you have to buy the security again to replace it in the account of the client from which the asset was borrowed. And in some cases, the financial institution or the broker, even without your consent, might liquidate your position. So they will cover your short position to avoid putting you in default. So if there is a risk that you will default, they will take an action and they will close your position at the expense of your own investment. So you might end up buying the stock at a higher price compared to the price at which you sold the asset. An important point investors need to keep in mind when being involved in the short selling is that if there is a dividend payment, for example, let's take a more concrete example. Now, let's assume that Shahad owns Sabiq stock. Okay, and I agreed with Shahad that I will borrow the stock from her in January and I will sell it in the market. So in other words, I'm going to short sell Sabiq stock. In February, Sabiq distributed 2 riyals as dividends. Who will receive the dividend on Sabiq stock? Is it Shahad who is going to receive the dividends, or is it myself, or it's going to be someone else? So think about it. Shahad gave me the stock, I took it and I sold it in the market. So the one who is going to receive the dividend is the buyer of Sabiq stock. And Shahad will not receive anything. And is that fair for Shahad? Is it because she gave me the stock with good intention, she will lose the chance to receive the dividends Sabiq distributed? No. In this case, the party who short sold the asset will pay the dividend. So in our example here, I will pay the dividend. I will pay to Shahad $2 riyals to compensate her for losing the chance of receiving the dividend. You can think of it this way. If you own the stock, you will receive the dividend. If you short sold the stock, you will pay the dividend. So this part is extremely important to keep in mind when we are dealing with derivatives and short selling. Does this only apply on stocks? No, it also applies on bonds, since bonds distribute coupon payments, and if you short sell a bond, then you will be able to then you will have to pay the coupon, the value of the coupon, if the bond short position is still uncovered. Now there might be a small fees for borrowing the stock, so someone will ask, okay, does the broker do this just to make you a favor? No, there are fees associated with short selling or borrowing securities. An example here, you short 100 shares when the price is 100, and you closed out the short position 3 months later when the price is 90. And during the 3 months, a dividend of $3 per share is paid. What is your profit? So to determine the profit you made out of this transaction, we need to have a clear idea about the cash flows that took place in the transactions you did. So today you took a short position, which means you short sold 100 stocks at 100 per share. So the profit or the revenue that you will receive as a result of this sale is going to be 10,000. Now, during the life of your during the life of this transaction, the company distributed $3 as dividends per share. Now, since you have a short position on this stock, you have to pay $3 per share to the party who lent you the stock. Why? Because since you already took the stocks from your friend, for example, let's say your friend gave you the stock, and you took the stock from your friend and you sold it in the market, and you promised that you will return it after 3 months. The company distributed dividends. Your friend is not going to receive the dividends because his own stocks were sold. So you have to compensate your friend by paying $300 for the dividends that he missed when the company distributed them. So you have to keep in mind that dividends and interest payments are a cost on the investor or trader who takes a short position in stocks and in the spot market. And then after 3 months, you close your position when the price was 90. So another term that is used is you covered your short position and you paid $9,000 to buy back the stocks. You take the stocks, you return it back to your friend. You thank him for giving you the chance to do this transaction. Now, what will be your profit? Your profit will be 700. Now, what do you think will be your loss if you had bought the 100 shares instead of selling them? Well, everything will be in the opposite. So let's say here you paid 10,000 in the case of taking a long position in the stock. You paid 10,000, you received 300, and then you sold it for 9,000. So net will be minus 700. That will be your loss. Okay. Now, before we continue or start discussing valuing forwards and futures contracts, we need to keep in mind some important assumptions. These assumptions include that there are no transaction costs associated with any transaction you do in forwards or futures, which is not that realistic, but we can still live with it. And another important assumption is that the tax rate on all types of trading transactions is the same. Moreover, and this assumption is key to our analysis, is that investors can borrow and lend at the risk-free rate. Now, if the borrowing rate is different from the lending rate, which is always the case in the real life, then our analysis has to be adjusted. But for now, we will live with the assumption that investors can borrow and lend at the same risk-free rate. Finally, investors will take advantage of arbitrage opportunities as they occur. Immediately when they observe an arbitrage opportunity, they will take action to lock in these arbitrage opportunities. Let's agree on some notations before we continue. S0 is the spot price today. F0 is the futures or forward price today. T is the time until the delivery date, and T is always expressed in terms of years. And this is extremely important to keep in mind. T is in moving forward in the course, and especially when we are using continuous compounding, T is always expressed in terms of years. And what is T? T is the time until the delivery date. When is the delivery date? And R is the risk-free rate of maturity T with continuous compounding. Now, we will be discussing in chapter 4 more about the compounding frequency, but you guys are used to the idea that interest rates could be compounded annually. And what do we mean by the idea of compounding? What does compounding means? Okay, based on your definition of compounding, you will say that the frequency of compounding is how much time it takes you to start receiving interest payments. So if, let's say, we are dealing with an interest rate that is 10% compounded annually, okay, then it means that if you invested 100 and you will receive 10%, which is $10, after 1 year. Nothing will be paid before that. I will defer a detailed discussion about the frequency of compounding for chapter 4. I will just touch base on the concept of continuous compounding. Now, in continuous compounding, it means that the frequency of compounding is continuous. It's a process does not stop. You invest, you pay interest, you receive interest, then you pay, you invest again, and you receive interest, and you reinvest again, and this process is done in a continuous basis. There is no intervals. While in a discrete compounding, like the annual compounding, you invest at a certain time, you have to wait for a period, then you receive interest. In continuous compounding, the idea is that the frequency of compounding is not divided into smaller intervals. It's a continuous process. And in finance, we borrowed this from physics and mathematics, in which there are continuous processes. So engineers will understand what do we mean by a continuous process. Okay. Now, if we are dealing with, before I continue, if we are dealing with continuous compounding, then the way to find the present value or the future, to find the future value, will be a different formula from what you guys learned before in previous courses. Now, in previous courses, if you have the future value and you want to find the present value, so you multiply the present value by 1 plus r to the power of t, right? Where r is the interest rate, the effective interest rate, and t is the number of periods. Now, in continuous compounding, it's the present value times e to the power of rt. R is the continuously compounded rate. T is the number is the period expressed in terms of years, and E is the is the Euler number. The Euler number, I think it's 2.7. So E is the Euler number that equals to 2.718, and it doesn't stop. So this is the formula to get the Euler number, and you will find it in most financial calculators and all scientific calculators, and we will be using them a lot in this course. Okay, so again, if we want to find the future value, it's equal to the present value times E to the power of RT. R is the continuously compounded rate, T is the number of periods expressed in terms of years. Now, if you want to find the present value of a number or of an amount of cash, then it's equals to the future value times or divided by 1 plus R to the power of T, which is equal to the future value times 1 plus R to the power of minus T. So that is when the cash flow we are dealing with is not continuous, or the interest rate is not continuously compounded. If the interest rate is continuously compounded, then it equals to the future value times E to the power of minus RT. So for discounting, we use minus RT. For compounding, we use E to the power of RT. Okay, let's look at this example here. Suppose that the spot price of a non-dividend paying, and the definition here of non-dividend paying stock is important, and the price, we observe that the 3-month forward price is 43, and we also observe that the 3-month US interest rate is 5%. Now we are wondering, is there an arbitrage opportunity? Well, let's see. Let's say someone told us, yes, there is an arbitrage opportunity, and to be able to take advantage of this arbitrage opportunity, you need to do the following steps today. So you need to borrow $40 for 3 months and return it after 3 months at the risk-free rate. You need to buy the stock from the spot market, which means you will pay 40 and receive the stock, and you will enter into a short position to sell the stock after 3 months for 43. So here we took a position in the money market, we took a position in the stock market or in the spot market, and we took a position in the futures or forward market. So here we by doing these steps, we locked in the arbitrage opportunity. Okay, what will happen after 3 months, or what could happen after 3 months? So after 3 months, I'm going to execute the forward contract, which means since I took a short position, I will deliver the stock and I will receive 43. Remember, 43 is the price, is the forward price at which I took a short position. So I don't have the stock anymore. I received 43. There is still one commitment remaining, which is the loan that I borrowed. So I have to pay back the loan, but before paying back the loan, I need to know how much I have to pay back. So the loan will grow to 40 times e to the power of 0.05 times 3 over 12. And why we did this is because remember, the interest rate that we are using is continuously compounded, and so that's why we used e to the power of RT, and t here is 3 months. So and since t is expressed in terms of years, we divide 3 by 12, we will get the amount of loan with the interest equals to 40.50. So I have to repay the loan, and then I'm left with 2.5 as an arbitrage profit. Okay. Profit. Now suppose that instead of the forward price as we observed it before is equal to 43, now it's 39. So it's then an arbitrage profit. And again, let's see. So today I will short sell a stock in the spot market and I will receive 40. Now these are the steps I need to do in order to lock in the arbitrage opportunity. What I will do with the 40, am I going to invite my friends in the restaurant? I'm going to use it for shopping? Of course, no. Since I'm an investor and I did this transaction for investing, then I will invest the 40 in the risk-free asset for 3 months. In other words, I'm going to lend this amount of cash at the risk-free rate. And finally, I will take a long position in a forward contract to buy the stock after 3 months for 39. So again, here you notice that I took a position in the spot market, I took a position in the money market, and I took a position in the forward market. So after doing this, I have to wait for 3 months, and then we will see how much I will profit. So after 3 months, the commitments that I have to fulfill or I have to deal with includes the futures contract and the short position in the stock market or in the spot market when I borrowed the stock to short sell the stock. Okay, so first I will start by receiving my investment in the risk-free asset. So I will receive the cash to use in executing the forward contract. How much will be my investment in the risk-free asset? It will grow to 40.5, and we found it based on the formula of finding the future value, which is 40 times e to the power of RT, and R is 0.05, T is 3 over 12. Now I have the cash to be able to pay to execute the forward contract and pay 39 and receive the stock. Okay, what I will do with the stock that I received, I will use it to cover my short position. Remember, why did I pay 39 and receive the stock? Because when I initiated these transactions, I took a long position in the forward contract. And a long implies that you are going to buy the asset in the future, and which means you will pay cash and receive the asset. Now, what will be my arbitrage profit? I received 40.5. I paid 39. So net, I'm going to receive 1.5. Now, you will notice that in the previous two examples, 40.5 was a common number. And it turns out that if we are dealing with an investment asset that pays no income, so no dividend, no interest rate, nothing, then the forward price we should observe in the market is equal to the spot price times e to the power of RT. Now we can call this the synthetic forward price. Which means we can create a synthetic position in the asset, okay, or a synthetic position in the forward contract, okay, by engaging in the spot, and which I will explain a little bit shortly after I explain this now. So here, this is the synthetic forward price. Now, if the price we observe in the market is different from the synthetic forward price, then there is an arbitrage opportunity. As we saw before, when the price we observe was 43, there is an arbitrage. When the price we observe was 39, there is an arbitrage opportunity. But depending on what is the relationship of the price we observe relative to the synthetic forward price, it will guide us on when we will take a long position in the forward, when we will take a long position in the spot, and so on. طيب, let's see. So the synthetic forward price is equal to 40.5, or the theoretical price for the forward should be 40.5. If the price we observe in the market is different from this value, then there is an arbitrage. Now here in this slide, we observed that the price in the market is 43, while the synthetic forward price is 40.5. Now, if that's the case, what should we do? We will follow a very simple rule, which states that you buy low, sell high. Whenever any investor wants to make a profit, he or she must follow this rule. You buy low and sell high. In our case here, where is high and where is low? We compare this price we observe in the market with the synthetic forward price, or the theoretical forward price, or the correct price that we should observe. If this price is higher than this price, then I will take a short position in the forward market. So I will sell high. I will take a short position in the forward market, and I will buy in the spot market. So to buy, I need to borrow cash to be able to buy. Okay, so borrow cash, buy from the spot, sell in the forward market, or short in the forward market. In this example here, again, synthetic forward price is 40.5. So we compare the price we observe in the market, which is 39, with 40.5. Since it is lower, applying the rule buy low, sell high, I'm going to take a long position in the forward market, in the forward contract. I will short sell the stock in the spot market and invest the cash I receive in the risk-free rate. So if you follow these logical sequences for the determining when you take long or when you take short in each market, it will become much more clearer. Now, let's assume that short sales are not possible. So one key issue to be able to take advantage of an arbitrage opportunity, especially in the second case here, is that we are able to short sell in the spot market. Now the question here, what if short sales are not possible? Does the formula still hold? Well, let's see. If F0 is greater than S0 times e to the power of RT, which is similar to the first case, first scenario, then I will borrow cash. Investors will borrow cash, will buy from the spot, and they will take short in the spot in the forward contract. Now, if F0 is less than S0 times e to the power of RT, this means I need to short sell, but okay, short selling is not possible. So is there still an arbitrage opportunity? Yes, but it's only available for investors who own the stock. So investors who already own the stock, they can sell it in the market, receive 40, invest it in the risk-free asset, and take a long position in the forward contract. This way they will be able to lock in this arbitrage opportunity. And since there are a subset of investors who can't take advantage of the arbitrage, then there will be a pressure on the prices that will make the arbitrage opportunity disappear. And it usually disappears in a matter of seconds, if not less. Why? Because there will be, for example, in the first case, there will be a huge demand to buy the stock, and there will be a huge orders to short the forward. Now, these orders to short the forward will put pressure on the forward price and make the forward price decrease. And the huge amount of orders to buy the stock from the spot will cause the price in the spot to increase until we reach a point where F0 is equal to S0 times e to the power of RT, and there will be no chance to do an arbitrage. Okay, so we covered the first case, which is dealing with an investment asset that pays no income. Okay, now what if we are dealing with an investment asset that provides a known income? Let's consider the following example. We observe that there is a forward contract to buy a coupon-bearing bond. The spot price of the bond is 90. So the price we observe in the market is 90. And the forward contract expires in 9 months. And there will be a coupon payment of 40 that is expected after 4 months. Now, the 4-month and the 9-month US interest rates are 3% and 4% continuously compounded per annum. Let's suppose that the forward price we observe in the market is 910. Is there an arbitrage opportunity? Let's see. Now, let's assume that someone told us that the forward price is higher than it should be. So, which means I have to take a short position in the forward market, and I need to borrow cash from the money market and buy the bond from the spot market. Now, which means I need to borrow 900 to buy the bond. Now, there are two ways in which I can borrow this 900. We have to keep in mind the following piece of information. If I borrowed today, okay, and I paid back the loan after 9 months, the interest rate, according to the question or to the example, is 4%. If I borrow today cash and I paid back after 4 months, I will pay only 3%. So what is better? Now, if I borrowed 900 and I bought the bond, should I borrow 900 completely based on the rate that pays 4%, or I can divide the amount I borrow between the rate that is 3% and the rate that is 4% to lower the interest expenses that I'm going to pay? Okay, one might ask, okay, why should I borrow based on the 3%? I need to keep in mind that if I buy the bond, I will receive a coupon payment after 4 months, and the coupon payment is according to the question. If we revisit the question, so it says that the coupon payment of 40 is expected after 4 months. Here there will be a coupon payment of 40. Now, isn't it better that I borrow the present value of 40 and I borrow it at the 3%, and the rest of the cash I need to buy the bond, I will borrow it at the rate of 4%. Is this better? Or I borrow everything based on for example, I will borrow 900 and pay 4% on it. Which one will lead to a lower cost expense? Of course, taking advantage of the 40 that you will receive after 4 months. So I will borrow the present value of the 40, and the present value of the 40 is equal to 40 times e to the power of minus 0.03 times 4 over 12, which equals to 39.60. So part of the 900 I need to finance the purchase of the bond, I will borrow 39.60 at the 3%. And return it after 4 months when I receive the coupon payment. The second part of the amount I need, which is 860.40, I will borrow it for 9 months at 4%. Okay. Again, why we are doing this? The whole purpose of dividing the amount we are going to borrow into 2 parts is to take advantage of the fact that after 4 months, if I bought the bond, I will receive a coupon payment of 40. So I borrow part of the 900 based on the present value of the 40. So after 4 months, the amount, which is 39.60, will grow to 40, I will use the coupon payment I'm going to receive to pay back this part of the loan. 860.40, this is an amount that I'm going to pay back after 9 months when the futures contract is going to expire, or it's the maturity of the futures contract or forward contract. Okay, so I borrowed the 900 and I buy the bond, okay, from the spot market. Okay, what else? Now I will short one or I will enter into a short contract, enter into a short position. In a forward contract. To sell the bond after 9 months. Contract, okay. To sell the bond after 9 months for 910. So we entered into a position in the money market, we entered into a position in the spot market, and we entered into a position in the forward market. So here we locked in the arbitrage opportunity. Okay. One mistake that many students forget when they are dealing with an investment asset that pays a known income is that they forget to deal with this known income. So don't forget what is going to happen with the 40, what you should do with it. Okay. Before we proceed, let's call this loan number 1 and this loan number 2. Now, after 4 months, when the coupon payment is paid, loan number 1 will grow to 40. I will receive the coupon payment and I will use it to repay loan number 1. So we are done with loan number 1. Okay. After 9 months, loan number 2 will grow to 886.60. And again, we used the formula for finding the future value of an amount using a continuously compounded interest rate. So I have to pay back this loan, but from where I'm going to get the cash, I will execute the forward contract, which means I'm going to deliver the bond I bought 9 months ago, and I will receive 910. I received 910. I will be able to now to pay back loan number 2, and then I will realize an arbitrage profit that equals to 23.40. Okay. Now, what if the price we observe in the forward market is equal to 870? I will leave this question to discuss over Slack. So I will see what you guys will come up with as ways to deal with this problem. Now, it turns out that when we are dealing with an investment asset that provides a known income, the forward price should equal to, or we can find the forward price by using the formula that tells us that S0 minus I all times e to the power of RT. And I is the present value of the income during the life of the forward contract. So if there is one dividend, we take the present value of this dividend. If there are two interest payments, then we will take the present value of these two interest payments. But one key point to keep in mind here is we involve in the calculation of I only the income that is going to be paid during the life of the forward contract. If there are expected some coupon payment that will take place after the expiration of the forward contract, we don't take them into account in the calculation of I. Okay, so again, this another name for this is the synthetic forward. Okay, so we compare always the synthetic forward with the forward price we observe in the market. If they are do not equal, then there is an arbitrage opportunity. Now, we looked at an investment asset that provides a known income, an investment asset that provides that does not pay any income. Now we will look at an investment asset that provides a known yield. Now, sometimes in the financial industry, it makes much more sense to express the amount an asset yields as a percentage instead of as a dollar amount. Why? Now, if I tell you that this asset provides or pays a dividend of 5 reals, and another asset provides a dividend of 3 reals, can you tell from only this piece of information which asset is much more profitable? Well, to answer this, I need to know what is the cost of entering into the asset first to be able to compare between the two stocks. But if I told you this stock will yield you a dividend that is equal to 5%, while the other dividend yields or provides a dividend that equals to 3%. So using a percentage here implies that 3% out of the cost of entering into the stock, and I can determine that the one that pays 5% is much more profitable for me, at least if I'm just looking at the dividends only. So that's why in the financial industry we don't see people use a lot or express a lot profits or returns in terms of dollars. They usually use yields or percentages. Now, in the third example here, where we are dealing with an investment asset that provides a known yield. Now, consider this forward contract to buy an asset that is expected to provide income equals to 2% of the asset price once during a 6 months period. The spot price of the asset is 25. Now, the yield is what percent per annum continuously compounded. To answer this, we need to understand what is the nature of the yield we are dealing with, and is it really continuously compounded, or we have to convert it to be continuously compounded. According to the question or the example, it tells us that the asset pays 2% once every 6 months. So we have to if we invest today, we have to wait for 6 months, then we will receive 2%, and then we have to wait for another 6 months, and we need to then we will receive another 2%. Based on the nature of these payments, are they considered discretely compounded or continuously compounded? Since we invest, we stop for a period, then we receive interest, then we stop for another period, then we receive interest or return, then the nature of this rate is that it is discrete. It is not continuously compounded. What I need from a rate is that to be continuously compounded, which means that every millisecond there is an investment and reinvestment of the asset and reinvestment of the interest until the rate matures. So he's constantly growing up until we find that this is the last day the rate is published or is used. So this 2% is not continuously compounded, and I cannot use it using the formulas that we are dealing with in chapter 5 unless also these rates are continuously compounded, because interest rate, in the first place, we are dealing with an interest rate that is continuously compounded, and the return we earn from the investment has to be also continuously compounded. So to convert a rate into a continuously compounded, it's a formula that we will learn in chapter 4, but I'm just going to use it here. So RC is equal to M times ln of R R divided by M minus 1. Actually not minus 1 plus 1, yes. Okay, so don't worry about this formula because we will discuss it and cover it more in detail in chapter 4. So just the application here of it. M is equal to 2, since this rate is compounded semi-annually every 6 months, so two times in a year, times ln of 2%, which is 0.02. So if we are using decimals, we continue using decimals. 0.2 plus 1, and this will give us 3.96%. Now here we found that the yield is 3.96% per annum with continuous compounding, and the US interest rate are 10% continuously compounded per annum. We want to find what would be the forward price if these are the parameters we observe in the market. So we observed that the spot price is 25, is 0. So F0 is equal to 25 times e to the power of R minus Q. R is the risk-free rate. Q is the yield the asset provides. So in our case, it's 10%, 0.1 minus 0.0396 times the maturity of the forward rate is so the forward contract is after 6 months, so 0.5 this will lead us to the forward price should be equal to 25.77. If the price is above or below 25.77, it means the price we observe in the market, I mean, it means that there is an arbitrage opportunity. Okay, so now the formula for using the forward price or finding the forward price for an investment asset that provides a known yield is that we raise e to the power of r, which is the interest rate, the risk-free interest, the risk-free rate, minus q, the known yield or the average yield paid during the life of the contract. Again, very important, during the life of the contract. And t is the period or when the delivery date expressed in terms of years. Now we found or we learned how to find the forward price. Now, after we signed this contract, does this contract has a value for us? So we want to ask this question at two different points in time. The first point in time is when we so t is the expiration or delivery date times 0, and let's say time x. Let's evaluate this contract at time 0. Does it make sense that anyone will be, let's say myself and Khalid signed a forward contract to buy 1,000 barrels of oil for 55. Now, after signing this contract immediately, can I take this contract and sell it to someone else for a higher price? Isn't it possible that other participants in the market can sign also the same contract using the same terms and the same price, assuming that the conditions in the market are stable? So I will not be able to sell this contract to someone else because it doesn't have any value, since everyone else can sign the same contract at the same time. Therefore, when we sign a forward contract, the value should be equal to 0. Now, later on, let's say a period of time passed. The value of the contract could be positive, could be negative. It depends on when we are looking at the contract, what is the new F0 that we observe in the market. And it depends on K at which I fixed the delivery price. So when I signed the contract with Khalid, okay, we agreed that the price is equal to K, and we at that time F0 was equal to K. But F0 is not constant, it changes depending on the price in the spot market. So later on, K is fixed, but F0 is will continue to change. So I need to later to value the contract at point X by looking at what is the F0 in the market and what is K I signed initially with Khalid. Then we will be able to find the value of the contract. And we assign the value of the contract the letter F. So to find the value of a long forward contract, so if I took a long position in a forward contract and I want to determine its value, I will assume that as if I'm going to take an offsetting position, and now in here I entered in the contract at time 0, right? And the delivery price was K. Then I closed or I want to value the contract at time X, as I said before, and I observe the price is equal to F0. It is as if I enter into a long that will be delivered at time T, and then I entered into a short that will be delivered also at time T, which is the expiration of the contract, and I will realize the difference at time T. But since I am not really at time T, I will discount the difference to the time I'm doing the contract. So I will multiply the difference between F0 and K by e to the power of minus RT. And this is the rate, the risk-free rate I observe in the market. And this is the T, the period of time between when I'm evaluating the contract and when the contract is going to expire. Now, if I am valuing a short forward contract, then all what I need to do is just to do the opposite. When I entered into the contract, I fixed the price K. When I want to value, I assume that I'm going to take an offsetting position, so I will close at F. Hypothetically, I'm not going to really close, but I assume that I will close at F0 that I observe when I'm valuing the contract, and discount the difference to today. So let's take an example. Assume that a long forward contract on an undividend paying stock was entered into sometime in the past, and there are 6 months left until the maturity of the contract. The stock price we observe today is 25, and the delivery price when we signed the contract in the past is 24. The risk-free rate is 10%, continuously compounded per annum. The question is, what is the value of the forward contract? So key elements I need to keep in mind is which position I'm trying to value. So I'm trying to value a long forward contract, and what are the inputs I need to value this forward contract. I know that a value of a long forward is equal to F0 minus K all times e to the power of RT minus RT. Do I have all this information? I have here that the stock price today is 25 and the delivery price is 24. So I know that K is equal to 24, but I don't know what is F0 because this is not F0, this is the stock price today. From this information, can I get F0? I know that the stock is an undividend paying stock. So I know that F0 is equal to S0 times e to the power of RT. I have S0, I have R, I know how much time left until the maturity of the contract. So yes, I can find F0. I don't have to get its price from the market. So F0 is supposed to be 25 times e to the power of 0.1 times 0.5, and this will give me 26.28. Okay, so we directly apply the formula and we will get 26.26 here, 0.28 minus 24 all times e to the power of minus 0.1 times 0.5, and this will give me 2.17. So the value of this contract is equal to $2.17. If I want to sell this contract, I should not sell it for a price lower than 2.17. If I can sell it at a higher than that price, good for me. Also, if I'm going to buy this contract, I should not pay for it more than 2.17. Okay? Now, the idea behind valuation. We started valuing derivatives, and we started now here valuing forwards or futures contracts. The whole idea behind valuation is that I need to estimate what is the futures cash flow. After estimating the futures cash flow, I will determine the proper discount rate. After I know I determine the proper discount rate, I find the present value of the future cash flows, and the sum of the present values will be the value of the asset or project, whatever I'm trying to evaluate. So here it's this valuing forward contract is not an exception. So here, to visualize the idea of valuing futures or forward contracts, sometime in the past I entered into agreement to buy the asset at K at time T, which and K we found it's equal to 24. Today, if I'm going to close my position, it is as if I entered into a contract to sell the underlying at the forward price we observe today, which is 26.28. Now, if I kept these two contracts together, I didn't close them now, just and waited until the time T, then I will realize the difference between the short and long positions at time T. So the 2 point, which is equal to 2 point, let's see, just a second. Yes, it's logically speaking, it's the difference will be 2.28, right? So this 2.28 is the value that I should realize if I waited until the maturity of the contract. But when we are doing valuations, we are valuing derivatives today. So not only derivatives, when any valuation task, you have to find the value of future cash flows that you expect in some time that you will receive in the future by finding their present value today. So to find the value of the contract today, I need to discount 2.28, and in general, when we are using derivatives, the proper discount rate, and there is a theoretical justification for this, is the risk-free rate. So finding the present value of the difference between the long and the short will yield 2.17. So that will be the value of my contract, my long forward contract. Now we turn to the issue of, should we expect the forward prices to be different from futures prices? Especially when the maturity of the assets are the same, and the maturity, the asset underlying are the same. Should we expect the forward and futures prices to be the same or different? Now, logically speaking, we should expect them to be the same. However, in theory, when interest rates are uncertain, And since futures contracts involve daily settlements and realizing gains and losses earlier than forward contracts, then we should expect a slight difference between forward prices and futures prices. And the difference depends on what is the correlation between interest rates and the asset underlying the futures contract, futures and forward contract. If the correlation is positive, so there is a strong positive correlation between interest rates and the asset underlying the futures and forward contracts, we should expect futures prices to be slightly higher than forward prices. And the reason for this is that if interest rate went up, then because of the positive correlation, we should expect the price the asset under the price of the asset underlying the futures contract is also going to go up, which means the futures price will go up. Now, for a person who took a long position, it means that his margin account will increase, and since his margin account will increase, he will receive more interest, because we know that any amount left at the margin account earns interest, even though the interest rate is very low. But usually the clearinghouse member or the broker, they pay interest to compensate you for holding money in the margin account during the life of your position. While if an investor entered into a forward contract, he will not have the chance to earn a higher interest income because of the increase in the asset and the interest rate. Okay, now there is a more technical analysis that will prove that we should expect a strong positive correlation between interest rates and asset prices. We should expect higher futures prices relative to the forward prices when there is a strong positive correlation, and if that's the case, when there is a strong correlation, a strong positive correlation, then when there is a strong negative correlation, it implies that if the interest rate went up, if there is a strong negative correlation, then we should expect that the futures prices are slightly lower than forward prices. Okay. Now we turn our discussion toward futures on stock indices. There are a variety of stock indices available. The popular ones are shown in the table here. The prominent indices are the S&P 500 and the Dow Jones Industrial Average. The S&P 500 is, as its name implies, it's a hypothetical portfolio that includes 500 of the largest US stocks, and the Dow Jones is based on 13 large US stocks, and you will see that there are other indices. One of the also known ones is the MSCI World, which is based on 1,500 stocks from 23 developed countries, and there is also the MSCI emerging market, which includes a large number of stocks from different developing countries or emerging countries. Now, futures based on stock indices. should we consider them as so should we consider a stock index as an asset that provides a known income, an asset that provides no income, or an asset that provides a known yield? It turns to be easier for us to consider a stock index as an asset that provides a known yield. And this known yield is the dividend yield that an investor will receive if he enters into the same portfolio and waited for a period of, for example, 1 year. And based on after this period, the investor will realize a certain percentage as a dividend yield. So why do we need this? Because we need to determine how is the futures price determined for a stock index based on the spot price. So we need to identify clearly the stock index as which type of an asset that provides a known income, an asset that provides a known yield, or an asset that does not pay any dividends on any income. So since stock portfolios usually they pay dividends, and we, instead of saying that this stock portfolio provides $10 as dividends, you cannot really compare the performance or between different portfolios based on the amount of dividends you receive. You need to compare the dividend you receive with another piece of information, which is how much it costs you to create this portfolio. So to get a percentage, and based on this you can compare between portfolios. So it's a standard in the industry that people use the yield instead of actual dollars, actual profit dollars. Now, if we are dealing with the stock index, and we should consider it as an asset that provides a known yield, and to find the forward price, we need to find what's the level of the index today, times e to the power of r, which is the risk-free rate, minus q, which is the dividend yield, times t, which is the time until the delivery date of the futures contract. Now, for a futures on a stock index, a good question is in commodities or in stocks, we know that usually there is, if the contract are not closed before the last trading day, then there will be an actual delivery. For a stock index, is it possible to make an actual delivery? It involves a huge amount of transaction cost. So for some futures contracts, settlement or delivery is going to be in cash. So after the last trading day, and both the long and the short did not close their position, there will be a settlement by comparing the status of the market with the price they entered into, and the winner will receive cash from the person who lost in the futures transaction. Now, what if we observe in the market that F0 does not equal S0 times e to the power of RT? Let's say first it's lower than S0 times e to the power of RQ times t. In this case, one second please. Yes, in this case there might be an arbitrage opportunity. Okay, but what do we need to do in order to take advantage of this arbitrage opportunity? So in the first case what I discussed is that we apply the rule: buy low, sell high. Like, where is low and where is high in this scenario? well, low in the forward market and high in the spot market. So it means that I have to take a short position in the spot market. And for example, if I'm dealing with 500 stocks, I need to simultaneously send an order to short sell 500 stocks that are included in the index, respecting their weight at the same time. And if I'm doing it manually, it will take probably an hour to complete such a task. So investors, they turn to relying on algorithmic trading, in which a computer will submit a large number of orders to be executed immediately and simultaneously. And I will take a long position in the forward market. If F0 is greater than S0 times e to the power of R minus Q times T, or the synthetic forward, then the same thing, I have to borrow cash, buy 500 stocks by executing 500 orders simultaneously to buy the stocks included in the index, and I will short the forward contract. Now, it could happen that sometimes the market will stop or will not allow for short selling. And if that's the case, we might observe a situation where F0 is less than the synthetic forward, but we cannot do anything about it because we are not able to short sell. Okay, so before I continue, let's consider here a 3-month futures contract on an index. And let's assume that the dividend yield is 1% and the current value of the index is 1,300 and the risk-free rate is 5%, also continuously compounded. What is the futures price? So applying the formula, which is F0 is equal to S0 times e to the power of R minus Q times T, we will get 1,300 times e to the power of 0.05 minus 0.01 times 3 over 12 will give us 13.07. So that should be the forward price we observe in the market. Now we will conclude our discussion of investment assets by looking at forwards and futures on foreign currencies. Now we should consider a foreign currency to be analogous to a security that provides a known yield. How? Let's say you have 1 million euros. Okay? How these 1 million, and you have them in an account, let's say in Germany. How we consider this 1 million to be an asset that provides a known yield? Let's assume you plan to keep it for a year at least. How this 100 million, 1 million euros will provide you with an income? Simple. You invest in the risk-free asset in Germany or in Europe, in the euro risk-free rate, and you will earn interest on that amount. Okay? So since we can consider foreign currency as an investment asset that provides a known income, a known yield, then we can use the formula for investment asset with a known yield to find the forward price of a foreign currency. So to find the forward price of a foreign currency, all what we need is S0, the risk-free rate at the home country, the risk-free rate in the foreign country, and T, which is the when the forward or futures contract is going to be mature, or when is the delivery date. Now, our objective, okay, or how did we reach this conclusion, or how this formula? We reached it by comparing between two scenarios. What are these two scenarios? The first one is, let's assume you have 1,000 units of a foreign currency. Let's say you have 1,000 euros. Let's stick with the euros again. What are the alternative options you can pursue to invest this amount and get the return of your investment after 1 year? Now, either I convert the 1,000 euros into dollars using the exchange rate that I observed today in the market at time 0, and then I invest this amount in dollars. I invested in the risk-free rate or a risk-free asset in the US, and I wait for 1 year. So I'll have a value. Okay. Now, alternatively, I will not rush and convert the 1,000 today. I will invest it in the risk-free asset in Europe for 1 year, and I will enter today in a forward contract to sell or exchange the amount I'm going to receive into dollars. So this amount should be equal to this amount. Otherwise, then there is an arbitrage opportunity. And we will see an example of an arbitrage opportunity. Now, suppose that we observe in the market the 2-year interest rate in Australia is 3%. The 2-year interest rate in the US is 1%. And the spot exchange rate is $1 Australian dollar is equal to 0.75. So what is the 2-year forward exchange rate? Well, applying the formula, S0 is 0.75. 1% is the risk-free rate in the home country. Since the Australian dollar is expressed in terms of US dollars, it implies that the investor is a US investor. Why? Now, if an investor in the US is going to buy something, is he going to pay in US or he's going to pay in euros or Australian dollar? Well, in the US, the currency that is accepted for daily transactions is US dollars. Now, if you are in Australia, you need to pay with Australian dollar. Since the price is expressed in US dollars, it implies that we are looking at the whole issue from the perspective of an investor who is a US investor. So 1% is the interest rate in the home country, US. 3% is the interest rate in the foreign country, RF. And 2 is when is the delivery date will take place. And we will find that F0 is equal to 0.7206. Now, what if we observe in the forward market that the price is not 0.7206, instead the price is 0.7? Is there an arbitrage opportunity? Yes. What should we do? Let's see. So applying the rule buy low and sell high, which we should follow whenever we are dealing with an arbitrage opportunity, I will borrow 1,000 Australian dollar from Australia and at 3% for 2 years. Why did I decide to borrow from Australia? Because applying the idea buy low and sell high, I need to sell Australian dollar in the spot market. From where I'm going to get the Australian dollar that I will be able to sell in the spot market if I don't borrow cash from Australia. So the starting point, if I'm going to sell high in the spot market, I'm going to borrow cash from Australia, convert it into US, and conversion means you sell AUD in the spot market and you receive 750 USD. I received from where I get the exchange rate 750 USD. Well, it's based on the exchange rate, the spot exchange rate that we observe in the market, which is 1 AUD is equal to $0.75. I received the 750 from the spot market from exchanging the Australian dollars. What should I do with it? Should I go and invite my friends for a big party, or I should invest it? Of course, since we are investing, we are taking advantage of arbitrage. I'm going to invest 750 in the risk-free rate, in the risk-free asset in the US. So in other words, I'm going to lend it based on the risk-free rate in the US for 2 years. I should not forget also that I need to enter into a long position to buy Australian dollars at 0.7 after 2 years, because remember, after 2 years I have a loan that I have to pay back, a loan I got from Australia, so I need to pay it back after 2 years when the loan is due. So I took a position in the spot market, I took a position in the money market, and I took a position in the forward market. Now I locked in the arbitrage opportunity. So what will happen after 2 years? Let's see. So applying the rule, after 2 years, my investment in the US is going to grow to 765.15. And how did we get it? 700 times e to the power of r, the US rate, the US risk-free rate, times t, which is 2 in our case, 2 years, and we get this amount. The loan in Australia will grow to 1,061.84 Australian dollar. Now, should I convert the whole amount I received from my investment in the US risk-free asset completely, so should I convert the whole amount, 765.15, into Australian dollars, or should I convert enough only to repay the loan? If I am a US investor, I need to realize my profit in dollars, in US dollars, not in Australian dollars. So to do that, I need to know how much I need to convert using the forward contract that I entered into to pay back the loan. So if I divided, or actually if I multiplied 1061.84 times 0.7, okay, I will get that I only need to convert 743.29 US dollars to get the amount that I need to repay the Australian loan. Okay, so again, I realize my investment in the US risk-free asset to be 765.15. The loan in Australia will be 1061.84. I need to pay back this loan. If I converted the whole amount here, I will get more than 1061.84, which is useless to convert into Australian dollar than to convert it back into dollars, since the investor is a US investor. So I only convert enough cash to repay the loan. So multiplying this by the risk-free rate, by the foreign exchange that I locked using the forward contract, I will get that I have to I can execute the forward contract and convert only 743.29, which will give me 1061.84 Australian dollar, which I will use to repay the loan. So this strategy will provide me with a profit of 21.87 US dollars. What if the price we observe in the market, the forward exchange rate, is instead of 0.7, it is, let's say, 0.78? Is there an arbitrage opportunity? Well, comparing the price we observe in the market with the synthetic forward exchange rate, we will find yes, they are not equal, which means there is an arbitrage opportunity. Okay, then in this case, what should we do? We will do the opposite of what we did in the previous example. Let's see. So applying the rule buy low and sell high, I'm going to borrow 750 US dollars at 1% for 2 years. Why did I borrow $750 from the US? Because applying the idea that I have to buy low and sell high, low for me in the second example is in the spot market. And from where did I get this? When we look here, this is the price I observe in the forward market, and this is the price, the synthetic forward price, which is based on this the exchange rate in the spot market. So it means that high for me in this case is in the forward market and low in the spot market. So how I will buy Australian dollar from the spot market if I don't have cash to start with? So that's why I need to borrow 750 US dollars, and I choose this number just to make our calculations much easier. And converting 750, I will get 1,000 Australian dollars. I will invest the 1,000 Australian dollars in the risk-free asset in Australia at 3% for 2 years. And we have to remember, we should not forget to enter into a short position to sell Australian dollars at 0.78, which is the forward exchange rate after 2 years. What will happen after 2 years? Let's see. So after 2 years, the US loan will grow to 765.15 US dollars. And the investment in the Australian risk-free asset will grow to 1061.84. Now, I'm going to execute the forward contract to sell the Australian funds and using the exchange rate that I locked using forward contract, I'm going to get 828.23 US dollars. So I will use part of this to pay back the US loan, and the rest will be a profit in my pocket, and this strategy will yield us a $63.08 as a profit. So we saw an example when the synthetic forward price is higher than the price we observe in the market, and when it is lower than the price we observe in the market, and how we can look in arbitrage opportunities. Now, next we will discuss the second type of assets, which is consumption assets. A consumption asset is an asset that is held by a large number of investors for consumptions, and it is not supposed to provide any income, but in addition to that, usually it is supposed to be subject to a significant storage cost. So for consumption assets, there are no income, but there are storage costs. Now, we want to examine the relationship between the forward price and the spot price to draw a conclusion on how the futures price or the forward price for a consumption asset is determined. Now, let's assume that we observe in the market that the forward price is higher than the synthetic price we observe for a consumption asset. And since we are dealing with a consumption asset and there is a storage cost, we can think of a storage cost as a negative income. So in the past, we used I, S0 minus I, in which I is the known income in terms of dollars. U here is the storage cost per unit of the commodity expressed in dollars. So assume that we observe this inequality between the two, between the spot and in the forward. Is there an arbitrage? Well, logically speaking, yes. And if there is an arbitrage, what should we do? Well, we need to take a short position in the forward price, and we need to borrow S0 times S0 plus U at the risk-free rate, and we will buy 1 unit of the commodity and pay for the storage cost. So either we pay for it now or we pay for it at the delivery of the contract, and we wait until the maturity of the forward contract. So we will deliver the commodity, pay for the storage cost, and we will receive the forward price. We pay back the loan, and we will keep the rest in our pocket. What if we observe in the market that F0 is less than S0 plus U all times e to the power of RT? Well, in this scenario, applying the rule buy low, sell high, I'm supposed to take a long position in the forward market or the futures market, and I need to short sell in the spot market. And here comes the problem. Can I short sell a consumption commodity? Can I short sell wheat? Can I borrow from someone wheat and tell them I will return it to you after 1 year, and I take it and sell it in the market and get its proceeds? And the answer is no. For consumption commodities, it's impossible that you will be able to short sell it, because people have or observe a value from keeping a consumption asset with them. They might be able to consume it, they might use it as a raw material for producing other products, So people usually will not be willing to lend others a consumption commodity. Now, sometimes we can express a storage cost as dollars or whole dollars, or we can express the storage cost as a percentage of the price of the asset. So we in this case, if it was a percentage, we will use this formula, which is F0, that is equal to or less than S0 times e to the power of r plus u all times t. You can see here that also here a consumption, a storage cost could be viewed as a negative yield. So in an investment asset that provides a known yield, Q is the yield we receive from the portfolio. Here, U is the percentage of the cost that we will pay to store the asset. Now we turn to the idea that derive the whole formulas that we observed for determining the forward price, and it's based on the concept of pricing by replication. So the idea of pricing by replication is that if you can create a portfolio in one way and you can create another portfolio in another way, but both portfolios will yield to this, provide the same payoff, then both portfolios should have the same price today. This is the rule of one price. If there are two commodities, they are exactly the same in every aspect, in terms of size, in terms of quality, in terms of where they are located, and you observe that these two commodities have two different prices, don't you think that there is an arbitrage opportunity here? Yes, you will buy the commodity with the lower price, and you will sell it using the price based on the price based on the higher price. Same here. Now, the idea behind the price by replication. Now, if you enter into a forward contract, we learned that nothing will be paid at time zero, right? And you have to wait until the delivery date, and you will pay F0. Can I replicate a scenario where I will pay only at time t and own the asset also, and own the asset at time t? Yes, I can borrow cash and I will buy the commodity from the spot market. Assuming there are no storage costs, I will wait until time t, and at time t I will pay the price plus the interest on the loan, and this will be the cost for me to own the stock after time t. If there is a storage cost, for example, I buy the commodity and store it, and let's assume that the storage cost is part of it's expressed in terms of percentage, minus plus C. So the cost of interest plus the cost, that's not C, plus the cost of storage, U, times Q. Times T. My mistake. Times T. So I buy the asset, I will store it, and after on the delivery date after time t, I will pay the price of the asset plus the interest on the loan plus the storage cost should give me the same what I observe in the forward market. Otherwise, there is an arbitrage. So the concept of the cost of carry, it means that how much it costs me to carry the asset into the future. So this includes the interest cost plus the storage cost. And if we assume that the asset provides income, then we will deduct from it any income that we earn. So for an investment asset, using the cost of carry model, the forward price is equal to S0 times e to the power of Ct. Now C is a container that includes the risk-free rate, the cost of borrowing, plus the storage cost, minus the income yield. So for an investment asset, we learned that depending on the asset we are dealing, this is the equation that governs the forward price. For a consumption asset, the equation that governs the or the inequality that governs the forward price is F0 should be equal to or less than S0 times e to the power of Ct. And C again is the same here. Now some parts could be 0, some parts could be like, for example, for a consumption asset like wheat, there are no income, so Q will be equal to 0. Now, is there something that we can do to convert this from an inequality to become an inequality, like what we observe here? The answer is yes. All what I need to do is to introduce a term y, so C minus y, that will make this small enough to be an equality. So from what observed here, this is higher than F0 or could be equal. To avoid this being higher, I will deduct from the exponent of E the term minus y. Now this minus y has a function. It's called the convenience yield. And this convenience yield has is also meaningful for participants in the market. Now sometimes y will be very high, sometimes y will be low. It depends on the conditions of the supply and demand in the market. The convenience yield exists more in commodities that are produced, unlike financial assets. In financial assets, there is no benefit from holding the asset itself in your inventory, but in the case of the commodity, holding an inventory of the commodity provides the holder the flexibility to alter the production schedule, and also provides an insurance against a shortage in the supply. So this convenience yield could change from time to another depending on the status of the supply. When there is shortage in the supply, we will find the convenience yield to be higher, and when there is abundance, there is there is no problem with the supply, we will find that the convenience yield is low. Now there is a way to estimate the convenience yield for an asset. Let's rearrange this formula to see exactly how we can find the convenience yield. So this is the forward price for a consumption asset with a convenience yield. So we can rearrange all variables in one side and the convenience yield in the other side to find the convenience yield based on the price we observe in the forward market and the price we observe in the spot market for the commodity. So we divide both sides by S0. We take ln of both sides to get rid of the fact that y is an exponent to e, and then we will get that the formula to get the convenience yield is as shown here. So we can estimate the convenience yield, and possibly we could do some further analysis about the status of the supplier in the market and so on. Now we will end our discussion of chapter 5 with the following question. Let's say today is October 1st, and we observe that the December futures price of wheat is 433 cents. Does this price tells us that the expected spot price of wheat in December is less than 433 cents, greater than 433 cents, or exactly equal to 433 cents? In other words, the expected spot price, not the futures price that we are observing today. No, the futures price, the expected, so since we don't know, the expected spot price at time t, is it equal, greater than, or less than 433? Now, there are multiple theories that try to address this issue. One states that if the majority of hedgers are investors who take a long position, which means that they are worried about the price will increase in the future, most likely the expected spot price is higher than the price we observe in the market, for the forward price we observe in the market today. Then why did they enter into the hedge? Okay. A quick revision. Now, Keynes and Hicks, they proposed the theory that mentions or explains that if the majority of hedgers are long investors, so long hedgers and speculators are short. So the futures price today is higher than the spot price or the expected spot price at time t. Why that's the case? Because the short investors, they the short investors who are speculators did not enter into this transaction if they are not going to be compensated. And how they will be compensated? They will be compensated by realizing a profit for bearing the risk. So they took a short at F0. How they will make a profit unless the price at time T is below the price at which they signed the contract. The hedgers are willing to let them or to buy from them at a price higher than what's available in the market or what is expected to be available in the market at time T for the sake of reducing the uncertainty, transferring the risk to the speculators, and the speculators will enter into such a transaction if only they believe that they will be able to make a profit. Now, if hedgers take the majority of hedgers take short, and the majority of speculators take long, then we should expect F0 to be less than the expected price in the spot market at time T. Why that's the case? For speculators to realize a profit or to expect a profit at least, they should buy at F0 and they should sell at time T at the higher price than what was F0. And the price will not be higher if the expected spot price at the delivery date is not higher than F0. So that's one set of a theory. The second theory is based on the modern portfolio theory. In this theory, let's assume or consider a speculator who takes a long position in a futures contract, which matures or in which the delivery will be after T years. And he hopes that the price, the spot price of the asset will be above the futures price, so he can make a profit. So he takes a long position in the futures contract, hoping that he will assume delivery and then will sell the asset in the spot market for a higher price. Now, to make sure that he will be able to buy the asset at time T, he is going to deposit in a risk-free account the amount equals to minus F0 times E to the power of minus RT, which is basically the present value of the futures price today. Okay, and if things went well and his expectation was correct, then he will sell at the end of the futures contract or at the maturity of the futures contract, and he will sell at ST. Now, he will not engage in this transaction unless he expects that he will make a profit. Now, let's we want to see what is the value of this investment today. So to be able to find the value of this investment, we should have we should consider the cash outflow and the cash inflow out of this investment. How we can do that? we need to determine what is the proper discount rate we should use to find the value for this investment. We assume that K is the expected return required by the investor to invest in this asset. So the present value of the investment, or the net present value of the investment, is minus F0 times e to the power of minus RT plus expected price of the spot price at time t discounted using the investor required rate of return. Okay, so we assume that all securities are priced so that the net present value is equal to 0, which means this should equal to 0. If we rearrange, we will reach this formula here. In other words, and if we further rearrange it, we will have the futures price is equal to the expected spot price times e to the power of r minus k, which is the rate, the expected return required by the investor on the asset, times t. Now, it turns out that our expectation of the future spot price will depend on its systematic risk. Now, if the asset is positively correlated with the market, which means it has a positive systematic risk, then we should expect that the forward price we observe today is less than the expected spot price at time t. If the price we observe in the market, if the asset is negatively correlated with the systematic risk, and this is reflected by the fact that K, the required rate of return, is less than the risk-free rate. In the first case, K, to reflect that the positive relationship or the positive systematic risk, K was higher than the risk-free rate. In the second case, K is less than the risk-free rate because the asset is negatively affected or negatively related with the market or has a negative systematic risk. So the forward price today we observe is higher than the expected spot price at time t. If there are no systematic risk, then we should expect the discount rate required is equal to the risk-free rate, in which case F0 is equal to the expected spot price at time t. So that's it for chapter 5. I hoped I was able to discuss and explain the concepts in this chapter as simply and easy as possible. Thank you for listening. Assalamu alaikum.